If you have $2.3 million saved for retirement, what's the most amount of money you can spend every year without going broke? Not how much you hope to spend or how much just based on market averages, but how much can you actually spend when incorporating real life risks? Most retirement advice starts with a number. Maybe it's 4%, 3.5%, 5% if you're feeling optimistic, but that number doesn't come from your specific life and helping you spend the most. It comes from history and assumptions of a safe number that's going to make sure that you don't actually run out of money. So this leaves you possibly spending way less than what you could have just due to the uncertainty, not wanting to run out there. So the better question isn't what's the rule that allows me to hopefully not run out of money, but the better question is what kind of plan actually holds up and allows me to spend more regardless of whether the market cooperates or not. In this video, I'll be comparing two different retirement scenarios. One is the traditional approach, market-based, probability driven, and I'll say what many people just naturally fall into without really knowing any different. The second is the alternative, which incorporates a very familiar, especially on this channel, but highly overlooked tool in retirement, which is permanent life insurance. This isn't going to replace all of your investments in the market, but what it will do is if you implement it correctly, it'll stabilize your investment losses and those downturns and act as a very trustworthy volatility buffer that's not going to be correlated to the market. We're going to look at the difference between the traditional and alternative plans here today, and you can decide which one you feel like would best fit your goals. My name is Justin Gartman. I'm a wealth coach here at Better Wealth, whose mission is to help you keep and spend more of your money in retirement with the help of life insurance. Before we really dive in, let's back up a little bit because I think it's going to be important to lay some foundation of how to approach retirement planning. So first, retirement planning is a system. I have a bunch of different moving parts, which can include taxes, asset allocation, liquidity, flexibility, and some guaranteed income sources. So I'll say if all of those parts aren't firing on all cylinders, it doesn't matter that you've been investing diligently into your 401k or saving really or investing into any vehicle for that matter for 40 years, your retirement can easily fall apart. So it's important that we know how to protect and maintain each of those components. Now, of course, if you optimize everything all at once, the results could be even better and you're going to have the best plan possible. But in this video specifically, we're going to intentionally isolate and change just one thing. So we're just going to change one variable because if changing that one lever can meaningfully improve how much you can spend without increasing that risk of running out of money, I think we'd all agree that's probably worth understanding. We'll start here with scenario number one, the traditional plan, and we'll look at the situation here. So here, all of this was put into financial planning software. So that's where these numbers and everything are going to come from. But right here, we're going to look at Harvey and Donna Spector, and they're a couple who's planning to retire within the next few years here. Here are their current assets, keeping it pretty simple here. Maybe Harvey lost some of his money from being a big time lawyer, and this is where he actually ended up here. So they have a few Roth accounts, have some qualified accounts, 401k accounts, all of that giving you a total $2.3 million. And their goal in retirement would be able to spend at least $185,000 a year. And that number, of course, is going to increase with inflation every year. So it's going to start off, you can spend $185,000 in year two, that goes up slightly, year three, that goes up slightly, and so on from there. This will also include Social Security. So we're assuming they just claim as early as possible, generates based on their income somewhere between $25,000 and $30,000 for them there. So that income is going to be factored in the total income that they're taking. Now, of course, you could look at when they take it, how much they get, all of that things. Again, we're not changing those. We're just looking at one variable. So it's going to be the same across the board. Traditional plan typically is going to look like this. So what we're looking at here is this red line is your income that's needed. So $185,000. Actually, it's a few years in for inflation and we're going straight up, of course. So this bar graph shows, hey, if the bar is hitting that, we had enough assets left and we didn't run out of money. We had enough that we could cover that. So this is where project the portfolio going at a steady assumed return, usually an average of 7% because, hey, market can easily average that, right? And you'll see the plan easily works. You get to the end and you still have plenty of money there, plenty of income to be able to spend down. Now, here's the issue though. This projection assumes a very smooth linear return. So assets are going up steadily every year at the average. Now, the market does not work that way. I think we all know returns are never actually average in real time. They're either way above or they're going to be below in any given year to get to that average number. And so when you're accumulating, volatility is not a major threat. We get that average and hey, we're going to end up where we end up. But once you start actually withdrawing, timing is going to matter significantly. And this is where that sequence of returns risk comes in. If a negative return hits early in retirement, while you're withdrawing income, it can have a much larger impact. If it's a little later, still has an impact, but it may not be as big. So instead of a just straight line assumption, we actually need to look at a range of outcomes. And so that's what we're going to do here is if we run a Monte Carlo simulation. So think of this Monte Carlo, for those who don't know, factors in thousands of randomized returns. So 1 year's good, 1 year's bad, and it gives you traditionally what can be an average and a range of outcomes. So here, if we look at that, what you see is that we see a very, very wide spread of outcomes. So what's happening here is we're starting off here, beginning of retirement, and this is our portfolio continuing to grow. In each situation, we have the top end, the bottom end, and then somewhere in between here. On the high end, you could end up with $4.8 million at the end of your lives. In the middle, you make it to right about age 90 when Harvey is assumed to pass away here. Everything again works out fine. We barely make it there. On the lower end, well, we fall significantly short. Don't make it anywhere close to the end. That's the reality, is that we really don't know what the order of returns will come in. We don't know the timing. We only know that volatility will exist. The spread of outcomes is very wide. The longer we live, the more uncertainty starts to compound. So yes, the traditional plan may work some of the time. And of course, adjustments can be made along the way. But who wants to make a dramatic adjustment late in their retirement years? But now let's change things and look at a different situation, an alternative plan. So here, what we're doing is we're assuming they actually have $500,000 less of market assets and instead have $500,000 of cash value in a life insurance. So there are multiple ways, of course, you could implement that. Could be funded over time, could have been built up years ago, could be funded as you get right before the final years of retirement. But for this example, simply wanting to measure the effect that having cash value available and using it to reposition part of your risk. And so what we're really doing is we're creating a non-market source of capital, and we're just going to look at the difference that makes. So yes, you see here, same situation. We're spending the exact same amount of money every year, but you'll notice the big thing is that spread where it was really wide shrinks down and we see it tightens up dramatically. Of course, the upside is really reduced, but you probably weren't going to end up there anyways and becomes much narrower. So it's more likely actually in this situation to end up closer to the high end because you don't sell market assets in down years, giving them a chance to recover. And you can actually be closer to that average of return simply by having more time in the market and them getting back to those averages. So you could end up just under 2 million, could end up slightly lower here in the middle. And then on the lower end, you could end up right about where we did in the middle of the other end. So that's where, of course, the goal here is to create a plan that works across more scenarios, good markets and bad. And of course, remember, we're not really even factoring in the death benefit here. So when Harvey passes away, Donna still be living here, that death benefit could inject additional capital into the plan. But I intentionally left that out, not shown here in these projections, because of course that would throw them off. And I'm really wanting to isolate the one variable of how the cash value can help with the volatility there. This is where this actually becomes practical. So we're looking at Monte Carlo and I have a wide range that I could end up with. I have a short range that I could end up with. How does that benefit you? Well, with life insurance in place and having that volatility buffer, you can spend the exact same $185,000 per year adjusted for inflation, and you can have greater certainty about not running out of money. So same dollars going in, less worry about where you're going to end up. Or if we look at another example, you can increase your spending. So in this situation, you see the spread here is still tight, but we've increased our spending here. So in this case, you can spend a little more, give yourself a 5.5% raise, which equates to about $10,000 more per year. That's every year. And again, adjusted for inflation. So the choice really becomes you can spend the same amount of money with life insurance as part of your portfolio, but that gives you a whole lot more stability. Or you can spend and keep the same and have the same probability. So you can spend more and keep the same probability. If you see here, probability of success where we first started was at 44%. Probability here is at 45. So spend more, have the same probability, or spend less and have a very certain outcome there. So stability or just more. And this, of course, doesn't mean you're locked into a rigid spending level. I think any retirement plan says, hey, here's how much you should spend every year. That's not going to be realistic. Really, in this case, with the life insurance, if market performs well, maybe you never need to use the volatility buffer. That'd be great, wouldn't it? In that case, you can just spend more comfortably, know that even if a downturn happens, hey, you have non-market assets that can be drawn from and it's not going to affect you as great. And so that's the difference. We're not chasing the highest possible outcome, but we're increasing the number of scenarios where the plan actually succeeds. I know that's a lot. Let's back up and wrap this up and summarize, I think, what the key takeaway should be. Retirement success is not about squeezing out that highest possible return out of your money. Traditional plans ask one big question: what rate survive the past that I can withdraw from my portfolio? I think the better question is going to be what structure, like we said, lets me keep spending when things do not go as planned, that allow me to spend more when things are good while not worrying that that extra spending will make me go broke. So permanent life insurance, when used properly, doesn't make markets better. It makes you less dependent on the good performance by repositioning some of that risk. And of course, it can make those other market assets perform a little better because you're giving them more time in the market. So when you reduce sequence risk, reduce income volatility, and increase optionality, something pretty interesting happens. You actually may not need higher returns or even a larger nest egg to safely spend more. And let's be honest, most importantly, live out your retirement with less worry and stress. Say, this doesn't mean everyone needs life insurance, and it definitely doesn't mean that life insurance is the only lever that you can mess with and pull as you're planning for retirement. But I think if you care about one question, how much can I spend in retirement without going broke? And let's be honest, if you've made it this far, and that's really why you clicked the video to begin with, right? So you do care about that, then I really think ignoring tools that improve the outcome doesn't really make any sense. If we look at this, it really comes down to the best retirement plan isn't the one that's going to look the best on paper. It's going to be the one that gives you more money in your pocket when life actually happens. And life is bound to happen. So let's help you be ready for it.